Inflation is not transitory. Inflation is being driven by massive federal deficits that have been going on for decades and have built out a huge debt problem. The deficit for fiscal September 2023 is going to be estimated at $1.2 trillion. This is going to be added onto our current debt level of $31.4 trillion. These are enormous numbers. But that's just the tip of the iceberg. We also have an unfunded Social Security liability of $22.3 trillion and an unfunded Medicare liability of $34.7 trillion. This brings those numbers up to $88.4 trillion is how much the federal government owes the world, either through beneficiaries or through actual debt payments. This is staggering numbers. The federal government's revenues, tax receipts via Social Security receipts and income tax receipts totals $4.9 trillion a year. This is just staggering that their debt is 18 times the amount of revenues they actually collect a year. This is never going to be able to be repaid. This is the root cause of inflation. The federal government has borrowed so much money and made so many promises that they will never be able to fulfill their promises without inflation. This is the root cause of inflation. We have managed to build out these huge deficits and huge debts, and there's no way to ever pay them off. The quantitative easing programs, where we took the Federal Reserve's balance sheet from $800 billion to $8.9 trillion, helped finance the deficit and kept interest rates low for over a decade, and allowed the deficits to really explode and the debts to really explode here over the past 14 years. They have now become completely unsustainable. The rhetoric going around right now about quantitative tightening and letting the balance sheet roll off, and they basically have let the balance sheet come down 3% on this $8.9 trillion Federal Reserve balance sheet. It's almost irrelevant. The root cause of the problem is the federal deficit, and as long as we have these massive deficits, we have no choice but have inflation. The Federal Reserve at some point in time is going to be forced to pivot back to quantitative easing and buying those government bonds. At this point in time, they are still very much saying that they're going to continue with quantitative tightening and that they're going to continue with their Federal Reserve rate increases, and those are going to continue for the foreseeable future, with the forecast now going toward 5% for the Federal Reserve reserve rates. So we are in a situation where the Fed is making noise like they're going to fight inflation, but the real culprit here is the federal government's deficit spending, and the Federal Reserve has enabled through low interest rates for the past 14 years for this really to get out of control and make it impossible for it to get back in the bottom. The reality is, the Federal Reserve is going to be in a situation where interest rates start to skyrocket. They've already gone up a lot. You're already seeing the squeezing out of private activity by higher interest rates. The mortgage issue is the biggest area. Mortgage rates have shot up in this increasing interest rate environment because there's so much demand for debt by the federal government that we've seen interest rates really skyrocket on mortgage debt, and that has been a big hit to housing and the ability for homeowners, especially new homeowners, to buy a home. And that's going to be a very negative impact on the economy, and this is going to roll over. This is also going to spill over into other economic activity. You're really going to begin to see a squeezing out of economic activity as interest rates have risen and will continue to stay high, as the federal debt needs to be financed at ever higher interest rates. The situation means that in all likelihood, the Fed will at some point be forced to pivot as the economic pain becomes too big and the financing needs of the federal government at ever higher interest rates becomes untenable. So at some point there will be a pivot. I don't think that's in the very near term. I think there's going to be more economic pain, probably another leg down in the stock market here. So I would remain cautious. The discussion about Federal Reserve interest rates and whether they're tight enough is somewhat comical as long as they're under the inflation rate. Inflation's still running 7-8%, and unless the Federal Reserve interest rate is over that, we're really not in inflation fighting mode. So inflation will continue to roar here for the foreseeable future, and even if it does pause, that will only mean that there's an opportunity for the Fed to pivot and start quantitative easing again, which will restart the inflationary spiral. Hope you find this information helpful. Please take a look at our website, buildingbenjamins.com, where you can sign up for email and text alerts and also see our full disclaimer. Thank you very much and have a great day.